Good evening, I'm Alessio, and tonight we're closing out the week with Wall Street looking remarkably upbeat, as investors digest a fresh wave of tech earnings, strong corporate numbers, and renewed enthusiasm around the artificial intelligence boom. The U.S. stock market ended October on a high note, capping another winning month that underscored the strength of America's largest companies and the continued dominance of the tech sector. But beneath the rally, there's a story of concentration, valuation pressure, and monetary policy uncertainty that investors simply cannot ignore. Friday's trading session saw the S&P 500 climb around 0.3%, the Nasdaq Composite rise more than 0.5%, and the Dow Jones Industrial Average inch higher by roughly 40 points, with all three major indexes finishing the month in positive territory. October delivered a roughly 2.3% gain for the S&P 500 and an almost 5% leap for the Nasdaq, its best monthly showing since April, thanks largely to one name, Amazon. The e-commerce and cloud giant blew past market expectations, reporting third-quarter revenues of about $180 billion, up sharply from last year, while its AWS cloud division accelerated to growth above 20%, its fastest pace in over 2 years. That segment, long viewed as the company's profit engine, has now been supercharged by the surge in demand for generative AI infrastructure. As a result, Amazon shares skyrocketed nearly 10%, adding more than $100 billion to its market capitalization in a single trading day and pulling the entire Nasdaq higher with it. Across Wall Street, traders were quick to call it a defining earnings moment of the quarter, a powerful signal that cloud and AI investment are no longer just narratives but active profit drivers. The enthusiasm spilled across to other tech heavyweights as well, boosting Microsoft, Nvidia, and Alphabet, as investors sought to ride the momentum into November. Yet while the headline story is one of strength, the subtext is a more complex picture of concentration risk. According to data cited by the Financial Times, nearly 60% of the Nasdaq's October gains came from just 5 companies, raising questions about sustainability and whether this rally is truly broad-based or simply another example of the Magnificent Seven effect that has defined markets since 2023. From a macroeconomic perspective, the rally is playing out against a delicate monetary backdrop. The Federal Reserve is entering its November policy meeting with a cautious tone. Officials continue to signal patience, even as investors bet on potential rate cuts early next year. Inflation data has cooled modestly, but not enough to guarantee a dovish shift. The Fed's language has remained hawkish neutral, emphasizing data dependence, which in practice means markets remain on edge, pricing in optimism but bracing for disappointment. A misstep in tone from Chair Jerome Powell next week could easily cool enthusiasm. The Financial Times noted that traders are caught between two conflicting forces: solid earnings that support higher valuations, and a monetary environment that still threatens to tighten liquidity if inflation surprises on the upside. Meanwhile, over in the earnings trenches, more than 70% of S&P 500 companies that reported so far have beaten consensus estimates, according to Barron's. However, revenue beats are less impressive. Profit growth is being driven more by cost discipline and share buybacks than by organic expansion. This is an important nuance. Corporate America is efficient, but not necessarily expanding fast. And efficiency has its limits when the cost of capital remains elevated. Analysts warn that if the Federal Reserve delays rate cuts deeper into 2025, high borrowing costs could start eroding margins, particularly in smaller-cap companies and consumer-facing sectors. The divergence between mega-cap strength and mid-market struggle is widening, a reality that will eventually matter to the indexes if breadth doesn't improve. For creators, investors, and those following the business landscape, there are several takeaways from this market phase. First, this is not the time for complacency. Markets are showing confidence, but that confidence is narrowly rooted in a few giant names and a narrative built around artificial intelligence and cloud transformation. If even one of those pillars wobbles, say, slower AI monetization or regulatory friction, the ripple effect could be significant. Second, for storytellers and analysts, this environment is rich material. It's about how technology is now functioning as both growth engine and macro hedge, how investor psychology clings to innovation as the safe haven, and how markets can look exuberant even when the broader economy remains uneven. There's also a global context to this rally. European and Asian markets have not mirrored Wall Street's enthusiasm. The FTSE 100 in London ended the week flat, while Tokyo's Nikkei slipped modestly amid a weaker yen. China's markets continue to battle sluggish consumer demand and housing concerns, reminding investors that the U.S. remains the outlier in resilience. Yet that very resilience, powered by massive tech valuations, invites comparison to earlier bubbles. The debate over whether we're entering a new AI-fueled bubble is alive again. But as one strategist told Yahoo Finance, if this is a bubble, it's one built on real revenue, not speculation. That may be true today, but the long-term test will be whether these companies can sustain double-digit growth without overextending into hype-driven spending. So where do we go from here? In the near term, expect volatility around economic data and Fed commentary. The rally has momentum, but it's also fragile, built on high expectations and crowded trades. A single earnings miss from a tech giant or a hawkish surprise from the Fed could spark rotation or correction. Longer term, the focus should be on balance, diversifying beyond big tech, watching for leadership in sectors like energy, healthcare, and industrials, and maintaining discipline even when the tape looks strong. The best investors and the best storytellers understand that resilience isn't just about holding gains, it's about staying prepared for reversals. So as October fades and November begins, markets are sending a dual message. Optimism is justified, complacency is not. Amazon's blowout results are a reminder of the incredible potential of innovation, but also a signal that concentration risk is real, and cycles can turn fast. For anyone following finance, content creation, or investing, this is a moment to stay engaged, analytical, and aware. Because in markets like this, the real story isn't just in the rally, it's in the rhythm behind it. I'm Alessio, and that's your business and finance wrap for tonight. Stay sharp, stay informed, and remember, momentum is powerful, but preparation is priceless.